How are you doing today?
I'm good. How are you?
Doing great.
It's been a while. We haven't been on a panel since NASDAQ a couple months ago.
It has. It's good to see you again.
And you.
So I'm really excited about this conversation today, kind of like dig into what's going on with applied AI and investment management. But I want to start with a little overview of what Kaiju is and kind of what sets you guys apart, right? You've been leading, running Kaiju for more than a decade now, I think. So talk to me about what's unique about your approach. And then secondly, I was under the impression that the way you made money in the markets was you have information that others don't. And here you are about to share some secrets. So why are you sharing your secrets, and will we make money off it?
Yeah, okay, despite the clickbaity title, I'm not going to share like all of the secrets, but maybe I can remove some misconceptions around the technology that we use. In terms of what makes us unique, we use exclusively predictive AI for making investment management decisions with no consideration of company fundamentals, which is, I suppose, unusual. Not many people have a high degree of comfort with that. Certainly traditional investors don't.
So you're not analyzing balance sheets, or?
We do not care. Don't care what the company is, don't care what it does, don't care what it makes, don't care what its last quarter is. We care whether or not it presents a predictable pattern that we can profit off of.
Very
and
nice.
That's it. It's pretty straightforward, but it's a disquieting concept for some.
Okay. So that's a I think, relatively unique approach. I work in finance. I work with fund managers, ETF managers all the time. I'm curious what led you to this practice, right? You're kind of a Renaissance man, applied cryptography, theoretical physics, scuba diving. Like, how has your journey positioned or led you to creating this capability?
Well, I think it's the realization that no matter how complex an investment analysis is, if you're a huge asset manager, you have 1,000 analysts coming to a conclusion, like, it results in a binary decision. You either buy the stock or you don't buy the stock. You short the stock, you open the position, you close the position. It's not an unlimited number of things you can do. And depending on what the objective is, that determines how you try to achieve it. So if you're trying to accumulate an enormous amount of stock and you don't want to move price, you're going to try to do that in a very specific way. You're going to use price, time, and quantity offsets, randomization factoring. You're going to use a combination of lit and unlit venues and try to enter this position causing the least number of ripples when you do so. But you're going to leave clues to what you've done, and we reverse engineer the decision based on that. So really, do we make a little less money than if you were first? Sure, but not by much. And we're right a lot more because we get to wait until we see that the pattern in which we have a high degree of confidence has presented. It's not, I don't think it's unusual from an ideology perspective. I think people just don't think about it that way.
So I want to dig into that point, because you, and I think a lot of the people you've hired, don't have traditional finance or investment backgrounds, right? You are building a team of people that think differently about the markets. Why is that so important?
I think we don't do it intentionally. It's not like we don't hire people with financial markets backgrounds. We tend to draw PhDs from academia who are focused on pattern recognition. And it's pattern recognition in genome sequencing, it's pattern recognition in climate data, it's pattern recognition in migration patterns. And it just brings a non-herd mentality to the process. There's a downside sometimes. You're trying to teach a PhD biochemist how your index spread strategy is going to work, and you say something like, oh, and of course, index options are cash settled, and you see the guy like, cash settled. And you're like,
I'm going to Google that.
Did you not know that? No, I did not. Okay, so you've got that, but random object collision for theoretical physics or genome sequencing in biochemistry, you're trying to predict a next outcome in data that seems random otherwise. And that's what price prediction is in capital markets trading. Where is this going to be tomorrow or Tuesday or next week?
Got it. And does that pattern prediction, investment management, trading, does it work over longer time horizons? Is that a successful application, or are we kind of constrained?
No. We've seen sort of no evidence that, and for good reason, we've seen no evidence that a machine is able to predict where something is going to be 3 months or 6 months from now. There are just too many variables, too much time passes, but tomorrow or the next day or 3 days from now, yeah, it's actually fairly accurate at doing that. Not in everything, not in every asset class. Global macro, for example, it's terrible at because it can't possibly figure out what the socioeconomic response to a global event is. We are looking at patterns in price, time, and quantity. Those types of patterns don't show up in what we're looking at. So we're looking at a response to short-term trading. It's highly accurate in about 3 to 8 days, or 1 to 8 days.
It's not a bad window.
Works for me.
I'll take it. Okay, I want to circle back and kind of connect dots between a couple ideas, concepts you've mentioned. One is focus on, just pattern recognition to identify trading opportunities. And the second is this need for you and the people at Kaiju to think, or any advanced trading firm, to think differently about patterns in the market, about the signals in trading activity that provide clues to what a profitable move is going to be. So it seems like what you're saying is like traders, fund managers just need to get more comfortable with the way computers think about the markets, the way they recognize patterns. Can you unpack that a little more?
Sure. I mean, by and large, humans don't like the way machines make investment decisions, right? We're used to following a linear logic path. When you make an investment decision, you're going to receive an opportunity. You're going to perform layers of analysis. You're going to look at comparables. You're going to maybe seek outside counsel. You perform risk assessment, et cetera, and then you make this decision of to invest or not invest. And it's explainable. You can tell somebody why you did something. And the machines take in vastly more data than we do. In our case, per decision, thousands of data points, and then perform billions of discrete examinations, and then it spits out a binary decision, yes or no. And that decision is based on an aggregated, weighted collection of thousands of criteria that's not explainable in the same way. We don't find that comforting. We think, well, I don't like this. I don't like that it just spits out this yes or no, and it's binary, and it can't tell me why, which is weird because as people, every single sensory or aesthetic decision you've made in your entire life worked exactly the same way. You walk into a room, you see somebody who you think is attractive, you say, wow, that person is attractive. You see a piece of art you like, you hear a song that you instantly like, you taste food. You don't go through a linear progression of why that is. If I stopped you in the moment and said, oh, interesting, why? You'd try to unpack it. You'd reverse engineer. Well, I don't know her. She's got nice hair and whatever. But that's nonsense.
Explainable attraction.
Exactly. And ultimately, you'd say, well, I don't really know. You do know. You just couldn't explain it. And it's not like we make only the most minimally important decisions that way. I mean, people start intimate relationships. People move to different states. They change their lives. They buy houses based on how they feel. And most people would say that they're not often wrong. They'd say, I listen to my gut, things like that. So I guess, yeah, it would be worthwhile for asset managers to get a little more comfortable with how machines make decisions, given we do the same thing, just not for asset management.
Okay. So we got to get comfortable with how computers make asset management investment decisions, and how are you applying these principles in practice? What are you developing, or what have others in the field developed to put these kind of worldviews, philosophies into practice?
Well, I'm not sure what others have developed, given that we're generally a pretty secretive bunch. I mean, we were happily
That's why
working
I'm
in
glad
the
you're here.
yeah, well, we were happily working in the shadows before OpenAI blew it all up. But for us, we don't build black box systems. So we don't just build an autonomous trading capability connected to capital markets and say, go make money. Each separate, what we call synthetic portfolio manager that we create follows a specific ideology. So we have a specific goal we're trying to achieve within specific risk parameters. We want this type of leverage. We want this maximal risk. We want this asymmetrical return on the risk. We want to utilize this much capital in this market. Build the strategy. So it's heavily guardrailed in terms of an ideology. And then the idea for us is that you mix and match these strategies to build the portfolio that gives you the greatest comfort. A little more risk tolerance. You'll use some strategies that are, kicking out 50 plus KGARs, but you're going to take a couple of drawdown risks over 10 years with that. If it's a little more conservative, you're looking at long only, you're looking at large cap equity, et cetera. So that's how we build strategies, is we start with the human component. It's a collection of traders and behaviorists and scientists sitting around going, I think this would achieve this goal, this strategy. You teach the machine, and then the machine refines it. And I've never seen a circumstance in which it wasn't able to vastly outperform whatever we started with.
Okay, interesting. So these AI trading models, I think you call them synthetic portfolio managers. You develop the human strategy, you build it into the model, you let it loose to manage a fund. Does it execute a static model from there on out, or does it self-teach? Does it self-learn?
Yeah, it wouldn't be AI if it didn't have a machine learning component, if we didn't use reinforcement learning. So, over time, it's constantly seeking to improve everything from execution to the pattern identification. And that's really what changed what was systematic and quantitative trading for years. This turnover was this component. With systematic and quantitative trading, it's static, right? It works for some random amount of time. And then the market shifts, the pattern changes slightly. Whatever it is, the strategy breaks. You've got to pull it off the shelf, dig under the hood, figure out, will it still work, et cetera. But with numerous hidden layers and machine learning componentry, you have this ability for it to constantly improve. So as the patterns change, the thousands of weighted criteria, the weights change, we don't touch it. It does that by itself. And it's interesting to look back after running these things for a year and a half, for example, and you run it against itself starting from the same point, and the performance is drastically better. And that's just because it's smarter. It's not because it knows what happened. You can blind it. You can remove all of its history, leaving only the decision-making capability. And I would say that, sometimes it can be a little disquieting. It's figuring some things out that maybe you're less comfortable with, but it's also enormously rewarding.
So the human developed trading strategy is like the kernel.
Correct.
That then you build the system to operate, and it almost kind of perfects that manifestation of a strategy over time.
Yeah, it can see things that you can't see. So, something might work for you for sometimes years. Some of the strategies that we start with, we've used successfully manually managing money, a decade and a half ago, and it performed really well. And the machine will skew it slightly, omit certain stocks from its asset class, or from its asset universe, because it's looking at vastly more data than we are able to. Say, well, you were kind of lucky, but this would be better.
But it's not telling you why.
No, it can't tell us why.
So I think you guys actually had, a synthetic portfolio manager running a public ETF for a period, right? Why did you choose to go the public fund route when you were already managing private funds so successfully?
Well, it wasn't for the basis point fee, I'll tell you that much. That was horrifying, but part of a different conversation. when you run these strategies within a private fund, there's naturally a certain amount of skepticism. Like, what are you seeing? What are you not seeing? And most of the strategies that we build are not 40 Act compliant the obvious reason being they're more profitable if they're not. And the risk tolerance within a private fund is vastly different from that of a public fund. And so we started getting feedback a few years ago that, well, I don't know that these types of technologies would ever work in a constrained, lit, listed 40 Act compliant environment. And we thought, well, let's see if they do. So we built this ETF, which was called DIP, and it was designed to capitalize on a retail trader fan favorite, which was buying the dip, only buying authentic dips, not just price retracements. It was long only. It used the S&P 500 universe. It sought to outperform the index. We ran it for 17 months. And when we took it down in May, its trailing 12 months was plus 33%. So it did the work. And then we got asset managers asking whether it was for sale. And weirdly enough, to have the conversations around that, we had to delist it.
Oh.
Yeah, like regulators, it's bizarre. We're still stuck in a regulatory framework where they're trying to protect the consumer from misleading quantitative strategies. And so we were not able to demonstrate that it had become smarter because they found that misleading. We couldn't show its 11-year model history relative to its on-model performance because that was misleading. So for us to have these deeper conversations necessary with a potential buyer, we had to take it down, which was, a little sad because we actually got emails from average people saying, "Hey, are you guys going to build another one?" That was
I really like that.
That was
working well for me.
Yeah.
Okay, little question for you. You, I believe, are a helicopter pilot, right?
Yeah, I'm
an amateur
helicopter,
an uncertified.
Pilot.
Okay, would you pilot your family?
Hell no, absolutely not. I'm a zombie apocalypse. If that happens, I'm your guy. Like, we're gonna make it out of there. But like a little tour around the Alps, no.
Okay, now would you let a synthetic portfolio manager run your kid's college fund?
Absolutely, I do.
Why? Why is that so much safer than you at the controls of a...
Okay, first of all, we'd never sat in a helicopter before. That would be self-evident. But, human error. It's the same thing. I mean, we want to believe that we are superior at everything, and we certainly are. Like, my experience with artificial intelligence is it's terrible at idea generation. It's not creative. Even the mimicry isn't very good. So, like, there's this role for us in the genesis of an idea, and the AI for us performs the refinement. So, take into the helicopter analogy, you have numerous inputs. I'm not as fast as a machine. Can I deal with this ever-changing condition? I mean, it's not like flying a fixed-wing plane. You're constantly moving everything. The machine can do this simultaneously, much faster. It didn't have a bad night's sleep. If we're talking about portfolio manage, it doesn't drink, it doesn't fight with its spouse. It's not concerned about whether its kids are going to university. It just looks at every tick of every stock that trades every day and performs billions of calculations. And then when it's done, it plays games against itself all night long and then comes back the next day to do it again. Like, if there's some guy, the SEC requires me to say things like may exceed human capability. If that person is in here, like, you're hired immediately.
The SEC requires that disclosure?
Yeah. We have to say things like, may exceed human capability. The 2 billion simultaneous transactions may exceed human capability. Like to meet that person.
I like it. Okay, so I want to close this out on this thought. Coming back to like pattern recognition and your origins, not in finance, right? These different fields, but you arrived in the markets in finance. Are the financial markets simply like one of the best domains for practicing applied AI? I mean, there's seemingly endless patterns, I would imagine, and the tangible value is right there. You can see it.
Yeah, absolutely. I mean, the huge benefit is that you have a closed ecosystem of data, right? You have price, time, and quantity. You have it from multiple sources. The data sanitization, I mean, it's heavy lifting, as our team will tell you, but it's not like trying to sift through unconstrained data for generative AI purposes, where you never know whether you've reached the end. We have a closed system, the patterns are available, and there's three variables. Yeah, in potentially unlimited combination of patterns, but I think it's a fantastic opportunity.
And so, last question, that pattern recognition capability and the fact that we're dealing with money and a highly regulated environment, does that ability to identify patterns, potentially even reverse engineer patterns, does that carry with it kind of unique ethical considerations that you've had to approach or wrestle with?
Yeah, once you're examining your market impact and you realize that, your pattern predation can cause behavioral changes, yeah, it falls to you to decide whether or not you're going to add a little push to a pattern that's almost there, that you need to be all the way there. You want to change some behavior slightly. Do we do that? No, we don't do that, because we're egotistical and like to think that we can win on a level playing field.
That's a restraint that you've applied.
Yeah,
to yourself.
but that's out there. People probably do and will do that.
Great. Thank you so much, Ryan, for the fantastic conversation, fascinating topic, and hopefully we can all get a little richer after this. Thank you.
Cheers.